96 rupees 56 paise. That is what $1 currently costs. The rupee has fallen 7.5% this year, and 100 rupees is now only 3.6% away. But look at the numbers behind this fall. India spent $49.8 billion importing crude oil in just 3 months. That bill increased by 61%, even though India imported 4.5% less oil. Foreign investors have withdrawn more than $28 billion from Indian equities this year. India's merchandise trade deficit reached almost $87 billion in one quarter, and the RBI's outstanding forward dollar sales have crossed $106 billion. These numbers tell us something very important. The rupee is not falling because of one headline, one war, or one government decision. It is being squeezed from several directions at the same time. And to understand whether 100 rupees is genuinely dangerous, we need to examine the 7 numbers driving the fall. On July 24th, the rupee closed at 96 rupees 56 paise per dollar. Its record low is 96 rupees 96 paise reached in May, and it has already lost 7.5% during 2026. That means 100 rupees is not some distant doomsday prediction. It is approximately 3.6% away. But 100 rupees itself is mostly psychological. Nothing fundamentally changes between 99 rupees and 100 rupees. The real issue is the speed of the fall and the forces pushing it there. The first major force is something India cannot stop purchasing. India imports nearly 90% of the crude oil it consumes. That makes oil more than an energy problem. It becomes a currency problem, a trade deficit problem, an inflation problem, and a national security problem. Whenever oil prices rise, India needs more dollars to pay for them. And whenever the rupee falls, those dollars become more expensive. India gets hit from both sides. But the scale of that hit becomes clear only when we see the third number. During April to June 2026, India's crude oil import bill reached approximately $49.8 billion. That was 61.2% higher than the same period 1 year earlier. But here is the shocking part. The actual volume of the imported crude fell by 4.5%. Import volume went down by 4.5%, while the import bill went up by 61.2%. India imported less oil but paid dramatically more for it. That is the simplest explanation of the pressure. During April to June of the previous year, the bill was approximately $30.9 billion. This year, it reached $49.8 billion. That is an increase of nearly $19 billion, and the country's wider net oil and gas import bill reached approximately $44.9 billion, up around 45% from the year before. That additional demand does not remain isolated inside the energy sector. Indian refiners and importers must enter the currency market and purchase billions of dollars. Whenever everyone rushes to buy dollars, the dollar becomes more valuable and the rupee gets pushed down further. But oil is not India's only import problem. India's merchandise trade deficit during April to June reached $86.86 billion. Think of trade deficit like a household budget. It simply means we bought more physical goods from other countries than we sold to them. 1 year earlier, the gap was $68.75 billion. That is an increase of approximately 26% in a single year. From April to June 2026, physical exports stood at $129.32 billion, while imports reached $216.18 billion, leaving that $68.86 billion gap. Exports grew by approximately 15.9%, but imports grew faster by approximately 19.9%. And in June alone, India imported $70.84 billion of merchandise while exporting only $40.41 billion of merchandise. That creates a constant structural need for dollars. India does have one major difference: services. Software, consulting, and digital services generated a surplus of approximately $49.43 billion this quarter, meaning we sold far more services abroad than we bought. That services surplus offset almost 57% of the goods deficit. A physical goods deficit of 86.86 billion minus a service surplus of 49.43 billion leaves a combined trade gap of $37.42 billion. Services are cushioning the problem, but they are not completely eliminating it. While India requires dollars to fund this gap, another source of dollars has been moving in the opposite direction. Foreign portfolio investors, international funds that buy and sell Indian stocks and bonds, has withdrawn approximately $28.03 billion from Indian equities during 2026 by July 20th. This creates currency pressure through a straightforward mechanism. A foreign investor sells their Indian shares, gets paid in rupees, converts those rupees into dollars, and moves those dollars back home. Every large foreign exits creates additional demand to swap rupees for dollars, and there is another feedback loop. A foreign investor may earn 10% profit from an Indian stock, but if the rupee loses 7.5% against the dollar, much of that profit vanishes when they convert it back to dollars. An India market return of plus 10% minus a currency loss of 7.5% leaves an actual return of around only 2.5%. That makes other global markets look much safer and more attractive. So, a weaker rupee encourages foreign selling, and foreign selling weakens the rupee further. But the investors are not the only people rushing to purchase dollars. Indian companies are doing it too. Companies that have to pay foreign suppliers don't always wait until the bill is due. They protect themselves through a technique called as hedging. Essentially, booking dollars today at a locked in price so that they don't get hit if the rupee falls tomorrow. In the week ending July 17, net forward dollar purchases by businesses rose to approximately $7.1 billion. Why? Because businesses were scared the rupee could weaken further. As the rupee falls, businesses fear another fall, so they rush to lock in dollars early. That sudden demand for dollars puts even more pressure on the rupee. That is not irrational speculation. For an individual company, locking in prices is sensible financial planning. But thousands of sensible companies doing it at the exact same time creates a stampede for dollars. So, we now have expensive oil, widening trade gap, foreign investors exits, and corporate dollar buying. Standing against all of this is the Reserve Bank of India. And its numbers are massive. In May, the RBI purchased $22.2 billion in the currency market but sold $28.3 billion. That made it a net seller of $6.1 billion. In April, it had already sold another $8.9 billion. Across those 2 months, the RBI pumped a net $15 billion into the market to keep the rupee steady. But direct dollar sales are only part of the story. The RBI's outstanding forward dollar sales reached record $106.6 billion by the end of May, meaning the RBI promised to supply $106 billion in the future, so markets won't panic today. The RBI has also introduced special schemes to attract foreign currencies. By July 17, these measures brought in approximately $20.72 billion, mostly through foreign currency banks accounts for non-resident Indians, the NRIs. So, this is not a passive central bank watching the currency fall. The RBI is selling dollars, promising future dollars, attracting foreign deposits, and stepping in whenever panic strikes. And this raises an obvious question. Is India running out of dollars? The answer is no. But the complete answer requires one final figure. India still holds approximately $675 billion in foreign exchange reserves, our national dollar savings account, providing cover for nearly 10 months of imports. That means India is not facing a classic balance of payment crisis where the country defaults on its bills. India can still pay for essential imports, pay off external debts, and supply dollars to stabilize the market. But $675 billion does not mean that the RBI can defend any exchange rate forever. Reserves are shock absorbers, not a permanent fix. They cannot fix our heavy dependence on imported oil, a wide trade deficit, or international capital running away. The RBI can slow the fall. It cannot cancel the global market forces causing it. What is already happening because of this? The impact is showing up across several parts of the Indian economy right now. First, import bills are expanding. India paid 61% more for crude imports despite buying less oil. That cost is already absorbed. Second, companies are panicking and locking in dollars. Weekly corporate forward dollar demand returns to $7.1 billion, showing that businesses expect continued volatility. Third, the RBI is using every tool on its balance sheet simultaneously. Fourth, international purchase power is falling for everyday people. Let's say a $50,000 foreign university tuition fee costs 42 lakhs when the dollar is at 84 rupees. Now, approximately at 96.56 rupees, that exact fee jumps to 48.28 lakhs. That is a raise of 6.828 lakhs out of the pocket without the university raising a single cent. Fifth, local businesses face hidden inflation. Consider an Indian software startup spending $10,000 every month on foreign cloud servers and AI tools. At 90 rupees per dollar, their annual bill is 1.08 crores. At 96.56 rupees, that bill shoots up to approximately 1.16 crores. That is nearly 7.9 lakhs extra in expenses without getting a single ounce of extra computing power. Sixth, dollar earners gain an advantage. India's service surplus reached $49.43 billion in the first quarter. IT companies, exporters, and freelancers earning in dollars right now get more rupees for every dollar they bring home. That is why a falling rupee isn't a purely good or bad for everyone. The real question is who earns in dollars, who spends in dollars, and who has the pricing power to pass the extra costs on to someone else. Now, what should founders take from this? The rupee story contains 4 direct lessons for founders. Lesson 1: test your business at 100 rupees and 105 rupees. Do not build financial projections using only today's exchange rate. Run stress tests at 3 scenarios: 90 rupees, 100 rupees, and 105 rupees. See how each level impacts your profit margins. Software costs, imported raw materials, and cash runaway. A business that looks profitable at 90 might bleed cash at 105 rupees. Lesson 2: fix your currency mismatch. If your startup earns revenue early in rupees but pays major bills in dollars, you are carrying a massive hidden risk. Founders must map revenue currency against cost currency. Whenever possible, build a natural hedge, meaning every dollar you earn as revenue from international clients to automatically balance out your dollar's expenses. Lesson 3: build currency protection into vendor contracts. Long term contracts that involve imported materials or dollar services should include price adjusted clauses. If the rupee drops past a certain limit, you must have the right to adjust your pricing or renegotiate terms. Signing a deal isn't enough, it has to stay profitable when exchange rates shift. Lesson 4: measure every dependency outside your control. India's economy gets hurt because it relies heavily on imported foreign oil. A startup carries that exact vulnerability if it relies entirely on one cloud provider, one foreign AI tool, or one international supplier. Ask yourself, what external factors could double down my cost tomorrow without my permission? That is the single biggest risk you need to solve. All the numbers that we discussed till now do not mean that India is collapsing. India still has world-class service exports and a massive $675 billion safety net in foreign reserves. But they prove that economic pressure is real. 100 rupees is not the end of the world. It is simply the landmark number that forces us to pay attention to the underlying pressure. The headline is the falling rupee. The real story is an economy paying far more for its essentials, competing globally for dollars, and using its saving buffers to absorb the hit. This is Moves and Meanings. I'm Satya Srivatsav. Here, we do not stop at the headline. We follow the numbers to understand what the move actually means.